Hello, and welcome to our very first webinar in our educational webinar series where we learn and explore different topics on real estate investments, financial literacy, and financial freedom. Thank you for taking the time to be here today, and thanks to everyone who's watching the recording. On this webinar, we'll hear from Trevor Thompson about investing in commercial real estate passively. He's an accredited investor and has invested in multiple real estate syndications, ranging from multifamily, land development to office strip malls. Without further ado, let's hear from Trevor.
So I used to be in the attractions entertainment business, spent the last 20 years with iFly Indoor Skydiving. I worked with that company, helped grow it from one location to 80 locations worldwide. There's my contact info, but anytime you want to learn anything, reach out and ask any questions. Disclaimer, this is not any offering. I am not an accountant. I am not a lawyer. This is things that I've gained, and it's for educational and entertainment purposes only. So hopefully I'm at least entertaining if we don't get too much education. So one of the things I always say about doing something is know your superpower. And my superpower is networking. So I like to connect with people. I am all over. So if you follow me on LinkedIn or Facebook, I am everywhere. I'm also very good at connecting people, finding people, putting people together, and then management from my experience of running small businesses, which I plan to convert to being a strong asset manager. Little explanation, an asset manager is the person in the general partnership team that is responsible for the execution of the business plan. So they're kind of the person, I don't want to say running the business, they're managing the people that are running the business. My strength is not PowerPoint. So we're going to muddle through with my PowerPoint, but we're going to learn and have some fun while we're here anyways. So what is passive investment income? It's very simple that you convert your time into cash. How do you do that? You go get a job, and your employer, you go start a business, whatever it is, you give that time, and then they give you a paycheck. Then you take a portion of that cash, all the cash, whatever you have, and you convert it into real assets that will produce passive income without your time. You know, we've all heard Warren Buffett's great saying, make money when you sleep. So this is what passive investing does for you. It takes that and it does it, and you do not have to put your time in it, and it continues to make you money. So what is a real estate syndication? It's an investment mechanism that puts real estate income within the reach of the average person. So we all know that we can't run out and buy big apartment complexes, lots of homes, lots of different things. We need to be able to have a mechanism to do it. And so syndication is that mechanism. So you invest in a sponsor's offering. So a sponsor is somebody who is sponsoring the deal, putting it together. They pool the funds with other investments. They combine it with bank loans to buy real estate. So as limited partner, you enjoy limited responsibilities and liabilities while still receiving your share of any of the profits. So this is a little bit about my journey. I've been in 17 different syndications. The first two have gone full cycle. I was asset manager for 10 months on one of the particular deals. I'm a little bit different that not all my investments are multifamily. I have retail, medical, 2 land deals, a single family home fund, a storage unit, and a buying. I did the single family home fund. So this is a list of them. And the bottom one here is my first deal where I am on an active side. So it's 240 doors in San Antonio, Texas. I might have mentioned earlier, I'm from Austin, Texas. So as the asset manager, I will make regular trips to the apartment complex to make sure that we are executing our business plan. Okay, why invest in real estate? Well, there's a big clue. 90% of all millionaires have become so through real estate. And another great statement is, don't wait to buy real estate and wait. And I clearly made this mistake. You know, I didn't start until my late 50s investing in real estate. And when I look and I see some of the young people that are coming up and they're investing in it, they are going to be in such a better position than I am because they will be producing money while we slept. While I slept, I didn't make any money for all of those years and missed a huge opportunity to be able to do that. There's also a big thing that really works well with real estate is tax breaks and deductions. And again, I'm not an accountant. This is just a very high level overview, but real estate investors take advantage of numerous tax breaks and deductions that can save taxes. So one of them is profits are delivered to investors as capital gains, which is taxed at a lower rate. Then you also get depreciation. So this is a kind of a funny thing. They call it the phantom loss. So you really didn't lose any money, but what they did was they depreciated the asset and gave you that. So there's several ways that it happens. There's the standard or straight line depreciation. So you buy something and over the 28 years, it goes down in value and you get to take losses on that depreciating value, which it really isn't depreciating in value, right? And everybody knows that real estate continues to go up, but they allow you to write this off. It's a wonderful thing. There's another thing called accelerated depreciation. And that's where they said, okay, you can write this off a little faster. Then they decided to go really crazy and they gave us this thing called bonus depreciation. And it is actually like crazy way to get some money back. So just to give you an example, I put $50,000 in a deal and I got $47,000 passive loss against my taxes. Now I want to make sure I'm clear that this goes off of your passive income unless you're a real estate professional. So I'll make sure you understand that, but it's still something that you can use and you can take several years, up to 5 years to be able to use that. So as you're building your passive income, this depreciation value will roll forward. Okay, and then how do you get it? So appreciation, we all know real estate tends to increase value over time. I know right now it's crazy. My house in Austin, Texas, in the last 3 years has gone up over 30% in value. It's fantastic. I really like it. Even if you look at the rest of the country, it's going up way ahead of inflation on a normal. Then there's this thing called forced appreciation. So that's where an operator makes improvements to the property, allowing them to increase rents. So this combined with improved management, new sources of income, creates this thing called forced appreciation. So you fix up an apartment, you make it due, and you're able to raise the rent. You find different ways to do charges, valet trash, parking, covered parking, all types of different things. That's how you force appreciation. One thing that a lot of people don't understand is apartment buildings are basically their net operating income with a cap rate. So when you increase your net operating income, it actually increases the value of the property crazy amounts. So like it can increase things like $25 a month rent increases, $25 a month in or per apartment in cost savings, and you can increase the value of apartment around $1 million. It's really exponentially combines itself on the commercial real estate market. It does not happen in your home. Your home never gets more than your neighborhood value, but apartments are all based on the net operating income. So what is a real estate syndication? Simple, it's a partnership between a sponsor, often called a GP, and a group of investors, often called LPs, which are limited partners. They together purchase a property that you otherwise could not afford. So who is responsible for what? The sponsor, the GPs. They're responsible for everything. There's a team. They normally each have their own individual things, but they're responsible for all aspects of the deal. Negotiating the purchase, arranging the financing, creating and executing the business plan. They have a huge responsibilities to their investors, banks, and partners. So they're the ones that are signing on the loan. They take all of the responsibility. Then passive investors, they provide working capital combined with bank debt allows you to purchase a property. So for example, we're going to buy a $10 million apartment complex. We can get a $7 million loan. We need about another $1 million for improvements to the property, closing costs and that. So we would raise $4 million, get a $7 million bank loan, and we would go out and buy the apartment complex. The goal is increase the value of the apartment complex. So try to make it worth 11 or 12, 13, 14, even $15,000 over a period of time. And then when you sell it, everybody shares the profits. So splitting of the profits, exchange for their efforts, at-risk capital, time, effort to execute the business plan, GPs receive a share of the profits. Okay, LPs have no responsibilities, sit back, collect And their profits are often called mailbox money. We all know nothing comes in a mailbox anymore. It comes through ACH through your bank account. So every deal is different. So the splits of what the GP gets can be very different, from 10% to 30%. And to be honest, there's even some deals like are at 50%. Let's put this in real simple terms. Make $1, the investors get 70 cents of the dollar, and the limited partners and the GPs get 30 cents of the dollar for their work. So that's kind of how the money gets split up. It's a very simple way to look at it. Now, to do all this, they have to create a thing called a offering memorandum, okay? Because in theory, when we syndicate an apartment, we are selling a security. So none of us are licensed to sell securities. It's very complicated, but they've created this rule where you can do it. So you create this offering memorandum, a legal document that states the objectives, not the objections, risks and terms of the investment involved with the private placement. The offering memorandum serves to provide the investors with information detailed in the offering to protect the sellers from liability associated with selling unregistered securities. I don't know how many people on the call have read one, but to be honest, it's 180 pages of "you're crazy to give us your money, but we think you should do it anyways." I mean, it outlines everything that can happen and go bad. But it's really, it has to give you all of your things, okay? It's there to protect the consumer. So they've said, okay, we're going to let unregistered people sell a security. We need to protect people, so they must disclose everything and anything that can happen in the world, right? So it's like saying you should never go to work because you may get in a car accident. You know, that you got to go to work, right? You got to do things, and you want to invest in real estate. There's different types of investors. I believe on this call, it's called accredited. So hopefully you all know who you are, but if you're not, it's someone with an individual income of 200,000 or 300,000 combined, or your net worth is worth $1 million, not including your primary residence. And as an accredited investor, there are two types of syndications, a 506B and a C. You can invest in both. Now, if you're not an accredited investor, you're limited and you can only invest in what's called the 506B. Talk a little bit more about that later. But what they have to make sure is that you're sophisticated. So how do you get sophisticated? You come to meetups like this. You go to different things. You educate yourself. You can join a real estate group. You do different things. You understand. And the concept is, again, this is the securities law saying we don't want people stealing granny's money. Right? We don't want these shysters showing up at granny's house, knocking on the door and saying, "Hey, granny, we're going to buy an apartment complex. Can you give us $100,000? And granny goes, "Oh, you look like a nice young man." So it gives you some rules what you're supposed to follow so that we don't do something like that. How to become a sophisticated investor. So again, it's someone who might have a high net worth or a high income. Additionally, investors highly develop investment and financial knowledge, which commonly leads to great investment intuition. So how do you do it? Attend meetups like this one today. Join other meetups and training sessions. Spend time on YouTube watching real estate sessions and attend personal meetups. You know, we met last week. There was 1,000 people at a meetup. It was incredible, and lots of great information. Who should you invest with? Okay, so I've simplified this because I'm a simple guy. I say that you should bet on the jockey, the horse, and then the track. I like to look at things very carefully. So who is the jockey? The jockey is the general partner who brought you the syndication. This is the person that you know, like, and trust. So there's somebody who's building up an audience just like we're doing tonight, and we're talking to different things. And eventually this all is so we can educate you. You can get an idea that we're trying to offer things that are very good. And so you know, like, and trust us. Then you're going to be partners for a long time. Some of these deals can go 7 years. Lately, they've been sort of 3-5 years, but it happens. You should research their track records, find out about them. I've done a background check on every person that I've invested in just to be safe. You know, they may come across, look good. You know, maybe you might watch me on the internet and say, "Well, that Trevor, you know, he looks like a great guy." I think I am. But again, you want to make sure. You also want to invest with somebody that gives you opportunities to learn. So these are opportunities to learn, right? We just don't want to say, give us money, let us go earn it for you. We want to educate you. We want you to understand what you're doing. And then, of course, opportunities for future relationships. It's quite interesting. The gentleman who ran the conference that we just went to, can give you an idea. He's probably 40 something, and he almost has $2 billion worth of real estate. Think of $2 billion worth of real estate in his fund. And he made a comment that about 30% of his investors are invested in more than 3 deals. So, this is a relationship business, right? You give someone your money and they give you a good return, and then you give them more of your money. Or when it comes back, a lot of these deals can double your money in 5 years. And so now you've got twice as much to invest. So you may split that and do 2 different deals, whatever you are comfortable with. So the horse is the asset. Now, this can mean a million things, right? So it can be apartments, it can be storage, it can be assisted senior living facilities, retail, hospitality, development. It can be anything, and it wants to be something that you feel connected with or that you understand a little bit. The quality of the asset, again, lots of things, right? So the asset class. So apartments come A, B, C, D. A means it's brand new with lots of amenities, very little deferred maintenance. B means what used to be an A, but it's like 10 years old now, and it's got a little bit of deferred maintenance. It's not quite as cool as the place that was just built this year. And then there's a C property. Okay, so that's an older property, typically like 30 years old. It's got some deferred maintenance, a lot of issues. So you're a little bit more careful. So again, more risk gets more reward, right? So an A-class property is less risk, but maybe less reward. Doesn't mean it's not profitable. It just means there's not this hope of a windfall, other than the crazy real estate market right now that gives you a windfall. But under normal circumstances, it's not. Then there's D properties. Okay, D properties are deep value add. Okay, that's where you put your purse in the trunk when you're going to walk your apartment complex because you don't want to get wonked on the head, or they are areas that really need some extra love. Okay, and again, there's money to be made in those. Especially with all the regentrification that's happening in downtown cores and suburbs, definitely some opportunities there. And then you could new build any of these assets. And all of those A, B, C, D, they're almost on everything other than like senior assisted living, hospitality. They have a little different thing. And then there's the track. Okay, so the track is limitless. Okay, so to give you an idea, my track is Texas, Arizona, North Carolina, and Florida. I'm not investing in any non-pro-business states, non-landlord friendly states. I want to invest where both of those things happen. So that's my track. But that's a very big picture, right? Texas, I don't know if you guys know, it takes 24 hours to drive across Texas, okay? I found that out the hard way. I had no idea that Texas was that big when I moved here. So there's everything in between, right? There's Austin, which is one of the hottest cities right now. Elon Musk is coming here making us famous. There's Dallas, there's Houston, but then there's all these submarkets in between. And then within these submarkets, there's submarkets, right? So you could be on a neighborhood and in this block, everything is nice. Go to the other side of the highway and it's like, what happened? I'm in a different location. So all of these things are limitless, but you need to understand a little bit just so that you know, okay, I'm investing in a gentrifying area. So it's rough right now, but we think it's going to get better. So we're going to invest in it. Nobody's going to put an A-class property in a D-class location. These things just don't happen. It takes time to build it up.
Trevor, I really appreciate your time. Thank you so much. It's an honor.